Hi guys, welcome back to my channel. In today's video, I'm going to go through a topic that I get asked about quite frequently, and it is how to let your winners run. So I know when you first start your trading journey, you look at your P&L, you're in a position, you're profitable, and you just want to take your money and run. That's not a bad thing. You can never go broke taking profit. However, there are ways that you can potentially optimize your profit and be able to catch an even bigger percentage of that move. What can happen is once you get out of the move, you realize that the stock is still continuing to make the move in that direction and you missed out on so much profit. And at that point, you either face some FOMO or you end up revenge trading because of the FOMO, and there's a could've, would've, should've complex that ends up coming into every trader's mind. And I'm going to go through some tips and tricks on how to avoid that and how to actually let your winners run. Now, I will say when I first started trading, this was a concept that I really struggled with. I just wanted to get in and get out. I did not care about the percentage that I made or my ROI. I didn't care about any of that. All I wanted was to get into the trade, be profitable, and get out. And that is not really how you evolve as a trader. You want to always keep getting better as a trader, and you're not going to get better if you're scalping that way. Also, taking very quick scalps, like 20-30-second scalps with very little ROI, is not a high probability, high quality setup. So I'm going to go through some of my tips and tricks on how to let your winners run, not to take profit so quickly, and be able to actually catch a more significant piece of the move. So the first thing and the most important thing is to always have profit targets. A lot of traders go into a trade and they don't know when to exit. And the issue with that is that you don't have a trading plan and you don't have profit targets. You always want to have profit targets for any trade that you take. So when the stock hits those targets, you know when to exit or you know when to scale out. So when you don't have profit targets, what can happen is that you end up getting greedy, you end up bag holding, you don't know when to exit, and then your emotions take over in that trade. Another really important thing to understand is that when you are up in a position, as human beings, when we see that, hey, there's money on the table or we're green this amount, you want to take your profit. You want to exit the position. You want to just be like, hey, I'm good. I'm going to get out. What happens is when you take profit too early, you then become emotional. What can happen, and what I've seen with a lot of traders, is that they are green on the position, they take profit too early, and then the stock ends up making another 10, 15, 20 point move up or down, whatever the side position they are, and then they end up getting FOMO. They end up feeling like they didn't catch enough of the move, and then your emotions kick in and you start to revenge trade. You want to jump back in and you chase the stock. And whenever you chase a stock, most traders know this, is whenever you end up chasing a stock, 90% of the time you end up red on that position. So to avoid getting emotional, to avoid revenge trading and FOMO, make sure that you always have profit targets. That is the first thing. The second thing is don't watch your P&L. This is kind of, every trader is a little bit different. Some traders like to watch their P&L because it doesn't affect them, and then some traders don't like to watch their P&L because it can affect you. I personally don't like to watch my P&L. I do usually watch the premium chart since I'm trading options, but watching your P&L, in my opinion, can hinder your trading, because when you see that, hey, I'm up on this trade, or hey, I'm down on this trade, you get emotionally attached to that trade. You get emotionally attached to your P&L, and most traders end up deterring from their trading plan when they see that they're big red, or they're, have a little bit of profit in their P&L, and they end up deterring from their trading plan and not following their trading plan. You either end up taking a loss, or you end up, like I said, taking profit too early and then revenge trading or chasing the stock afterwards. So that being said, in my opinion, I don't think you should watch your P&L. I think it helps you get a lot further as a trader when you're not emotionally attached to what you see in your P&L. Another tip is learning how to scale out. So for me personally, I'm usually never holding a position to 100%, to 150%, to 200%. If I enter a position, I have multiple profit targets to the upside or downside, depending on what side of the position I'm in. So let's say, for example, I would want to take puts below 43.85 on SPX, okay? My profit targets to the downside, let's say, will be 43.75 and 43.70. Usually my profit targets are the next levels of support and resistance that I have to the upside or downside. In this case, there are levels of support to the downside. So if I'm entering SPX puts below 43.85, as it approaches my first profit target of 43.75, I'm going to scale out 60 to 70% of my position at that first profit target. As it clears the first profit target into my second profit target, I'm going to scale out another 10 or 15, 20%, depending on how much I scaled out at the first one. I usually like to be at 90% of my position at the second profit target. The rest of my position, I usually hold. They're called runners. Okay, so if they run, they can run to 100, 200, 3%. If not, I'm just going to follow my stop, keep dropping my stop, and I potentially sometimes I break even and sometimes they go to 200, 300%. It really depends on the day. However, I already know that I've locked in 80 to 90% of my profit already. So you're taking off the risk that you had initially put onto the trade. You're taking off the risk. That then decreases how emotionally involved you are in the trade, and you are more likely to hold those runners to bigger profit targets or to bigger percentage gains than if you were to hold 100% of your position. You are less likely to be emotionally involved in the trade if you have already taken some of that profit off. That is the best part of scaling out and taking profit as the stock makes the move. If you are not taking profit and you're holding 100% of your position, especially on a stock like SPX or SPY where it's very volatile, you could potentially give back 50, 60% of your position when you were, 50 to 60% of your profit as the stock makes a pullback or reverses. So the best thing you can do is to set at least 2 profit targets. If you only have 2 profit targets, you take 70 to 80% of your profit at that first profit target, and then you take the rest at the next profit target that you have set, or so on and so forth. Usually I set 2 to 3 depending on the day that I see or the move that I see overall. If it's a 20-point gap fill, I usually set 2 profit targets. If it's a 30-40 point gap fill or a 30-40 point move or a 5-10 point move, depending on how the stock moves and the trade that I see will depend on how many profit targets I set on that stock. The main takeaway for this specific video is to understand that you can scale out. You don't have to hold 100% of your position the entire move down. No trader is holding 100% of their position in a 100-point or 50-point move on SPX or a 5-10 point move on SPY. And I will leave you guys with this last little tip / piece of advice. All of this comes with experience. When I first started trading, I did not know how to scale out. I did not know how to take profit. I did not know how to let my winners run. I was not confident in the setups that I was taking, so I was trading very scared. And this is how I think a lot of newer traders trade. They trade very fearfully. So they enter a position and they're like, oh my God, oh my God, oh my God. If it's not moving as quickly as they thought, they start to freak out. Once the stock does make the move, they immediately take profit right when they're green on their trade. And honestly, I was like that too. So it's going to take you some time to be able to get to the point where, hey, I'm going to take profit at my first profit target. I'm going to take another 20% at my second profit target, and so on and so forth. And I'm going to let my winners run, and I'm just going to keep dropping my stop loss on them. Whatever happens, happens. If they break even, great. I know that I've already taken 80% of my profit. I've taken that risk off from this trade, so I'm comfortable holding my runners. And it definitely takes time to get to that point. So don't be so hard on yourself if you are taking profit. Like I said in the beginning of the video, you will never go broke taking profit. Okay, so don't ever think that just because you took profit, you're doing something wrong, because that's not the case. You can always take profit, wait for a pullback, and then re-enter the position. However, if you take profit, just understand, try to make sure that you're not emotionally then getting attached. If you, for example, take profit, you wait for the stock to pull back and then you re-enter. If you take profit and then you feel FOMO and try to chase the stock, understand the difference between the two. Understand what you're really doing. Are you waiting for another high probability setup for a re-entry point, or are you chasing the stock? And being able to differentiate between those two is really, really going to help your trading journey and take you a lot further as a trader. All right, guys, so that's it for today's video. If you have any questions about anything that I went through, go ahead and comment it down below. Make sure to like and subscribe to my channel for more content, and I will catch you guys in the next video. Bye.